For every dollar of excess return that you capture, somebody else must be willing to lose $1.
So this is what we said at the beginning, reaping the rewards in the good times and avoiding losing in the bad times.
And that's the critical point, this is all about portfolio construction. Typically, our client who have an advisory contract with us, they have, in my opinion, a tendency to spend hours discussing with their favorite investment coach or advisor, single name, single instrument, single fund. They should spend far more time discussing the portfolio globally and its construction. Is it well built? Is it well diversified? Is it robust? In case of shocks, our portfolio engineering team can help stress test a portfolio. They should spend far more time discussing this and much less time discussing the individual lines in the portfolio. We do buy stocks on which, guess what, Anna? We have absolutely no view whatsoever on these names. We add them to the portfolio because the risk engine tells us when you add them, portfolio construction is more robust.
Okay, you mentioned risk, and that's great because you wrote that a majority of expected returns are generated by harvesting the risk premia of the asset classes that make up the portfolio. So, is risk more, if not equal, to performance when you look at a portfolio?
Well,
is it just as important?
No, I think, first of all, it's pretty obvious that the source of return will be the risk premia. I think there's one commonly accepted fact in the investor community globally. The collective performance of the investor community is the market performance. And for every dollar of excess return that you capture, somebody else must be willing to lose $1, okay? So you don't want to sit at that table and be the patsy who is subsidizing excess return for others. And this requires a very structured investment process, a lot of discipline. And it's like yoga, gymnastics, or other artistic activities. It takes a lot of brain training to get to that level of discipline. And because managing money is always that subtle mix of art and science, you don't want to be completely psycho-rigid, and stubborn. And that's why some managers are so successful at managing money, very few ones, that because they have that unique ability to be disciplined but flexible when need be.
All right, so what should investors consider when hiring a manager? We've kind of gone through what our investment process is, but from the other side, what should clients be looking for?
I would argue two things. First of all, nobody will show you a bad track record. So the track record is a good thing, but it's just one element in the decision. More important is how that track record was produced. We were once looking at a very successful hedge fund manager, and detailed analysis of the track record revealed that one stock decision contributed since inception more than 100% of the total return of the fund since the beginning. In other words, everything else that was done in the portfolio didn't detract or added, but he got one decision right. What are the implications going forward? You invest in this fund, you're betting that for the next 10 years, he's going to find that second stocks that will outperform massively and compensate for everything else, So this is an extreme example, real one, that illustrates that you need to understand how diversified the source of returns are. It's great to look at the track record, but frankly, it's meaningless in isolation. You need to understand how it was produced. And therefore, you hire an investment manager, but you essentially hire an investment process. And if you don't understand how that investment process works, what are the choices? And by the way, there is no one single universal recipe that is best than all others' recipe. So you have to make a choice, what type of approach you want to have. But you need to understand the merits, strengths, and weaknesses of that approach. And you need to understand when the approach works and when it doesn't work. Because sometimes returns are disappointing in the short term for the exact right reason. So the typical example you hire a value manager because you want to have some value equity strategy in your asset allocation. We have a growth stock market leadership for a while. You have to compare the guy against other value manager and value indices. If you compare the performance of a value manager against growth manager when growth is leading, you're going to make counterproductive decisions and fire the manager, usually shortly before the market regime shifts back to value.